Good morning, traders. TGIF. We are going to wait for Ryan to join us. There he is. Hello, Ryan. Are you there?
Yeah, hello.
Hey, TGIF, mate.
Good morning, mate. I'm still laughing over what we've been arguing about in the room. Yes, good morning, everyone.
You
having a bit of a moment this morning. What?
You had to rewrite the whole script of the flow show.
Yeah, I had to throw what I was going to talk about in today on the show in the bin. We were just having a discussion over the ECB stuff in our chat room. Yeah, I'm getting a bit confused which is not difficult because it seems Lagarde's just as confused as I am. Just over how they're all going to split these rate hikes. Is it going to be over 1 rate, 2 rate, or 3 rates? How they're going to do it? And yeah, I'm just getting myself in a bit of a mess. More confusing than I need to be. But anyway, we'll talk about that in a moment. So good morning to you all. Hope you had a good day yesterday. Hope you stayed safe. Bit of a chop fest in the euro, which we'll talk about. Just quickly, we'll go over some of the events that have come out so far overnight. Not too many. China, these lockdowns that we spoke about yesterday, potentially in Shanghai, look to be getting closer. There's more talk about those. These 7 districts that are going to be testing over the weekend. Some other areas potentially going under lockdown. There was a bit of speculation going around, and the FT picked up on it. I think from the same tweet I saw earlier about a possible run on China banks in Shanghai. Now, as I say, the FT jumped on this. We did, if you remember this week, have that news that China were apparently going to be building a big bank rescue fund. So maybe there's a case of people putting 2 and 2 together and coming up with 5. The fact that this is apparently happening in Shanghai could be more related to the potential lockdowns. You know, if people are going to be locked down, they potentially going to be rushing to the bank to get cash out because they've still got to potentially buy food and that sort of thing. So it's not definitive that these stories on a bank run in China is related to anything, financial stability or anything like that. But the headlines are there, so something to keep an eye on. So that's it from the China side anyway. From Japan, we did get a little bit of data out. The Japanese version of PPI, which is called the corporate goods price, if you've seen it called that, just a little bit softer than what we've seen previously. This is May data, so it could mean that inflation isn't ready to really feed through and kick on a bit. It's still running at high levels, 9.1%, as you can see there, down from the prior 9.8%. Expected was 9.8% as well. Year on year, on the month, it came in flat versus 0.5% expected, prior 1.3. So yeah, one of the things that the Bank of Japan is looking at is whether inflation is sustainable. PPI is a very volatile number. So it's not saying that inflation is going to drop or anything like that. It just might mean that the core numbers, if you like, the main numbers, may not rise as fast as maybe some people would expect given the global inflation situation. But more importantly from that, we had a meeting of the Ministry of Finance, Bank of Japan, and the Financial Services Agency, I think it's called, the FSA. And they've stepped up their rhetoric on watching the currency. What we've had previously is they're watching it, they're keeping an eye on it, but it's pretty sort of low level warnings. They've stepped that up. They've said, if you can see the news thing there, they're going to be watching it even more carefully and with a sense of urgency, and talking about they could respond if needed as appropriately. So this is just another little step up the rhetoric ladder on warning about excessive moves in the currency. As we mentioned this week, what I'm personally looking for, and I'm I think Kay is as well, is if we start to step into the speculative bracket. So if they start saying that a lot of these moves are becoming highly speculative, they're not based on fundamentals, that'll be yet another big jump up in the rhetoric, and that takes us closer to potential intervention. Now, we've spoken yesterday about the general playbook for Japan, the government, how they approach these things. So far, there are new members in the government. So what happened, back in 2011 with the big interventions, that sort of thing, these are different people here, but it does seem they're following the same playbook in terms of they have their different language steps. And as they step those up, we get closer and closer to intervention. So if we get into that speculative comments situation, then we're getting really close to potential intervention. And then we have to take care of that, watch out over the weekends, because they do have history of going early Monday morning their time, which is late Sunday night, UK, Europe, that sort of thing. So I don't know if you want to add anything to that, Kay, on the Japan stuff and the language we're getting.
No, not really. That's what we said yesterday, and you repeated today. Next week is Bank of Japan, and I think it's going to be a high-risk event for the Japanese yen. Potentially both sides, right? The market, if they don't do anything, the market will take it in their stride and probably hammer the yen again to go and test the intervention levels. We had a few banks coming out saying that they expect intervention sooner or later, but probably not before 140 in the dollar yen. Personally, I don't think they have a fixed level in mind. They're looking at the speed, and they are also seeing that the yen is not only weakening versus dollar, but versus the rest of the world, really. And so as I've been saying, even though Kuroda and friends in the Bank of Japan are saying that it's too early to do something, they might start to discuss about something, and that may filter through after the Bank of Japan meeting. So I'd really be careful though with the yen. I'm still not a yen buyer, but into the Bank of Japan, I could see myself try to buy some cheap downside just in case something happens right after the Bank of Japan. And I think they're meeting on, it's going to be Friday morning for us. So we get a Friday morning, then the weekend. And
it's quite a late one, isn't it?
It's a late one, but as you say, something about the Sunday night, Monday morning over there. Imagine that they don't do anything. It's Friday. The market goes like all banana selling yen again, and then they come in on the Monday morning. So it's going to be a high risk event, in my opinion. Next Bank of Japan meeting next Friday. So be a bit careful.
Yeah, I'm thinking the same thing. It's going to be a big risk event because, as you say, if they stand pat on policy as they've expected to, don't make any language changes, you're probably going to see 135 taken out pretty quickly. And then, as you say, if there's some big volatility there, they're going to be sitting on the sidelines watching and waiting, and that running that risk over the weekend may not be the wise thing to do if you're long yen pairs. So for now, just on those headlines alone, you can see this big red candle on the 15-minute chart. That was the headlines coming out there. I managed to scalp about 24 pips because it took a while for the market to pick up on those comments, really. And then I got out, and then we got some other comments from Kanda, the currency diplomat, just after. Where was that? Here. Just in the press, he wouldn't disclose what they discussed, but they will take appropriate action as needed. That gave it another little kick down in the end there. And then after that, I decided to take a short, another short at 133.50, probably too hasty. So I exited that at 93. So I gave all my money back plus a bit more. But I am thinking that we're going to be seeing some decent stuff going on here. Now we've got the Bank of Japan next week. We've got this solid looking top now, as I mentioned before. I want to see, if you want to look for price action developing a top, look for this sort of action. We've had 3 sort of tests of the highs here. They're not been in line. In a perfect world, I'd like them to be right bang on an exact level. You know, we had a high here, then it went a bit above, then it's held just below. But in the main, you know, we've got 3 definitive tops there, which does give you greater conviction now to try short. But again, this being a Friday, we've got the CPI numbers coming up as well. You know, there's a lot can go on today, and I'm going to be getting a bit more wary about being long yen pairs over into a weekend if the rhetoric from the Bank of Japan Ministry of Finance is going to ramp up on potential action. Because if they do act, you know, Sunday night or Monday morning when us in the UK are asleep, it could be a bit messy. But as Kay said, the way to look at it really is to perhaps look at options if you have access to options, just plain old vanilla options. Take some downside protection, maybe buy some out the money puts, you know, 200 pips below, something like that. It's something I'm going to look at to do potentially over a weekend, even if it costs me a few pips and I get out the following week. Just to, if we do get something going on when I'm not at my desk, it's one way of a low risk way of capturing any potential big moves, because when you're trading options, your risk is limited to your premium if you're buying them. Obviously, if you're selling options, then your risk is unlimited. So anyway, that was the Japan thing, and we'll look at currencies in more detail there. Obviously, the big news today, or the big data today, is going to be the US CPI. The new reading. This always comes before the PCE, which is the preferred Fed's method, but inflation is inflation. That's what we'll look at. Also, we've got the Canada jobs numbers, so that's something to keep an eye on for the Bank of Canada. They were waxing lyrical last night about how more hikes might be needed. Pretty hawkish sounding in the main, I think, Kay, last night, weren't they?
The Bank of Canada.
Yeah.
Yeah, they have been very, very hawkish, although in their financial stability review, they did caution about risks to the economy. So that was a little less hawkish, and I think the market, who is likely quite long Canada, I think, decided to take some back of it, and we had a pretty steep rise in the dollar Canada last night after it really kicked off when okay, the whole dollar turned, but it really kicked off after the FSR review. They did put a bit of caution in there, so I guess the positions now are much lighter. So yeah, any positives, any positive on the labor report could send the Canadian dollar back up, in my opinion. The risk is that if data start to get weaker, market will reprice some of their hawkishness on the Canadian rates. So it's going to be an interesting one this afternoon, that Canadian labor report. I think actually for volatility wise, it could be more important than the US CPI.
Yeah, cool. That's interesting. So just looking at the US CPI, so we're expecting the main headline rate year on year to come in largely unchanged at 8.3%. The core here to dip slightly to 5.9% versus 6.2% prior. Now the market is going to be looking at, and as we said this week again, about when you look at the fundamentals, the market is really matching this data to the Fed's path. The Fed's path is 3 more hikes of 50 BPs. So this data will bring some changes to those expectations. Not hugely, but we'll see some minor adjustments around them. Obviously, the bigger the variation of this data, the bigger those changes will be to those expectations. So if we come in the core CPI, you know, anywhere around about 5.5% to maybe, you know, up to that 6.2%, the changes aren't going to be that big. We probably won't see huge price changes. And so roughly anything out of sort of 5-point move either way. So if we get something above 6.2, if we get something below 5.5 for the core, then we're going to see bigger moves in the market. If it's much better than expected, then we're going to see yields jumping again. We're going to see the dollar jumping again. Obviously, on the other side, if it comes in much weaker, then the market is going to sort of price out a bit of expectation for the Fed. Dollar will drop, yields will drop, that sort of thing. Same for the CPI, really. Give it a 5 pip move either side to judge whether it's going to be a more volatile market move or not. Anything around 8.6, 8%, something like that is middle of the road. So how that's all going to feature in, let's compare it to the ECB, and we'll obviously look at what happened there. Just quickly pull up the euro. So we had the ECB meeting, and as you know, I had my little cheat sheet going. In my opinion, the ECB was probably more towards the hawkish side, but the market didn't react to that. Or it started to react to that initially when we got the news on the hike. But as we were saying, if it can't break the levels, then that's what you've got to look at. And the fact we couldn't even get up to test this 78.6 fib, the 108 area that we've been looking at and we've been highlighting, that gave a big flagging problem, a big red flag that there was going to be a problem. I actually went long. I had to go long. I was itching, and I took a punt long at 107.33 just before the announcement. I managed to knock the majority out up to 107.60s, and then I got done on the trailer at 106.90, giving it all back. And I was worried we couldn't get up and break this level up here. And if we can't do that on what is potentially a hawkish tilt from the ECB, that suggests that there's trouble coming, and here we are just dipping below 106. So what does it mean in the bigger picture? Well, the ECB they're starting their hike cycle, but it's going to be at a much lower pace, a much shallower rise than the Fed. So that's taken the hawkishness, the market hawks out the picture a bit. They've had to bring their sights down a little bit. And in the wider divergence trade, it leaves the Fed running ahead of the ECB. So even though the ECB hiking, they're not going to be running at the same rate as the Fed. That's going to keep increasing the divergence trade, hence why we've seen the dollar gain and particularly the euro lose ground purely on that divergence basis. So what do we need to look at? We need to look at the downside. And personally, I don't really envision seeing the euro, crumbling too much. They are still hiking. So, can I see the euro down to 105? I think where we are now, it's going to take probably a big CPI reading out the US. And if we do get down there, I'm going to potentially be looking at longs. As I say, because they are still hiking. If we get down to 105, that's a 270 pip move, which is, in my mind, would look a bit excessive. But the price action is going to be my guide. If we do crunch down there, I'm going to have a think about, is this really a change in trend, or is this just the dollar reasserting itself? But we look at the levels. If it gets down to 105 and it can't break 105, in the same way it can't break the 38.2 fib and the 108, then that gives me some conviction to try a trade there and add to my existing long. On the other side, the other euro pairs, again, similar situation for euro sterling. We did get a push up to near that 86 handle again, but it got slammed. Again, this is a divergence in play. The ECB not hiking as fast as the Bank of England will be. We're looking at 50 pip hike expectations for the next Bank of England meeting. So again, this is a divergence trade in effect. Does it mean it's going to collapse to 83, anything like that? I don't think so, because the ECB is still the far bigger bank. So again, it's going to be a case of watching the levels, and we've got this 84.80, 85 area down here that's been on off support. So if we find that we're holding there, that's going to give a better conviction for longs. Under there, then we may be looking at a move down to the low 84s. We hit the next support point. But overall, the ECB and Lagarde, she made a bit of a mess of everything going on about the the fragmentation tool that everyone's talking about. She spent a lot of time talking about it without saying anything, and in effect, it doesn't look like they've got a tool ready at all. So that's to be developed. But even so, I think the market is looking a lot at this fragmentation tool when really it's just an emergency measure. So as we said yesterday, it may be euro positive in the sense that they're going to bring this tool out and it's going to be supportive of any future problems. But if they have to use it, it means there's been something negative happening. So that's going to be euro negative. But in the grand scheme of things, I think it's still small news. Anything you want to put in on the ECB, Kay?
No, not really. I think that there's disappointment about this fragmentation tool, because reading through the lines, they could actually use what's left of the PPP, even though they would use it in a case of whatever pandemic. But she let something go at some stage that they know what to use, they know how to use it. So I read it or heard it like as saying like, oh yeah, we still have some of that stuff. But where I think it was, that particular point was a bit negative euro, is that they don't seem to have a tool where they would support, because they say when the spreads widen too much, we are going to buy peripheral bonds. But they didn't say that they would keep the bond flows neutral. So that is to really bring the spreads down, they should buy peripheral bonds and sell core bonds, yeah, like the German, the French, Dutch, whatever. But she hasn't said anything about keeping the flows neutral. So in my opinion, the negative part of that is that they might just continue to buy peripheral bonds, but not sell any others, which would then dampen the effect of any rate hikes somewhere. And I think the market took that really badly at that point.
Yeah, I think there's also maybe some confusion in the market, because I've seen a lot of comments with people tying the PEP to this fragmentation tool, and I'm not sure that's correct. If you read the ECB statement, they talk about fragmentation in regards to the PEP, and that they will use the PEP on fragmentation that occurs from further pandemic issues. So it's not other issues that may cause fragmentation. Yeah, well, the PEP is purely for pandemic stuff.
Yeah, but you can.
It's almost like two fragmentations. The PEP is for a pandemic fragmentation, and there's other.
They can use it as an excuse. They can use it as an excuse. The supply lines are still distorted. That's a result of the pandemic. Bang. They can use it. They can use it.
Oh yeah, no, I understand that, but I think what they're trying to develop is something for further, for the bigger picture, further down the road past the pandemic, rather than keeping PEP for fragmentation in 2 years' time because some banks gone bust or something like that.
They'll give it another name with the same funds.
We haven't had a new acronym for quite a while, so one is due. So no doubt this tool will get a big fancy name, and probably the Fraggle or something like that, the fart. We'll think of one, and we'll hear about that probably in September. But anyway, so talking, going back to looking at some of the prices. So yeah, we're in a bit of a flux at the moment. The euro's had a bit of a kick in from yesterday. Want to see what develops here. Are we going to get a bigger move down? The CPI is going to be the big risk here. Same for dollar yen. We've got this now fairly decent defining top up here, developing top. Is the CPI data going to come in strong and break that? Is it going to come in negative, and are we going to see dollar yen drop, yields drop, and how far can that go? We've got a bit of a low here into the low 133s. We've obviously got this former break area here at 133, 132.90. That's going to be the first real place to monitor. If we break through there, we could have a bit of a slip down into the low 132s. And really, the main number we're looking at is down at this break point here, around about 131, 25, 30-ish. That will, if we get down there and we hold there, we'll perhaps get a similar situation to what we had here, where we had the 131 highs, then we had the 127 lows. We had a little mumble under there, but largely we've held it. So that was a range we were looking at a week or so ago. So potentially we've got the ingredients to have the same similar sort of thing happen here, where perhaps we do get a look down to maybe 131, that prior break point, as I mentioned, and then we see a bit of a range between the highs 134.50 and that area there. But that's something that needs to be developed, and we spoke about it when we were watching this 131. I traded off the 127 when we got down there, made a few pips, then got lost a bit of back trying some shorts there, and then I had a nightmare shorting all the way up to the area here. But when we look at price action, this is what we want to look at. Where are the levels going to show up? Where is the main support and resistance going to show up? Once we get those main touch points, once we identify those and the price actions confirm those, then it gives us a bit of confidence to trade the range. And if you want to trade in the middle and look at what develops in the middle, you can do. You pick up your levels. We find some levels popping up and down within the range. So that's what I'm going to be looking for dollar yen, at least, seeing if we find a range here, looking to trade the range, taking the news on board. I am still keen to keep a short bias based on the Bank of Japan next week, based on the fact that we're stepping up the rhetoric from the officials there. Kay, I know we had and yep, so that's pretty much it. I'm on a bit of wait and see for dollar yen, but I'm in the back of my mind, I'm keeping a short bias for that pair. Yeah, Kay, you were looking at the Scandi data earlier, particularly the US CPI. So do you want to grab the screen for a minute?
Yeah, sure. Let me grab the screen. Just a quick one. It's going to be mainly on the Norwegian kroner. Where is my screen? There it is. Let me just, you guys seeing this, I hope?
Yep.
Where are my Scandis? There they are. Just on the Norwegian kroner. So this morning we had the Norwegian CPI and PPI out. Well, let's not even talk about PPI. That's globally around the globe, up in the clouds. Don't know when this thing. It was a little lower than the prior one, but we're still around 65% year on year. I always have to laugh when I look at such numbers. We used to see PPI numbers somewhere like 5, 4, 3, 2, everywhere now like 65. What was it in Spain the other day? 80s also.
Yeah, so silly, wasn't it? Yeah.
Yeah, but so yeah, this morning CPI came out again on the hot side. It slowed just a tad on the month-on-month, but then the year-on-year data, both the headline CPI and the core CPI year-to-date came out higher. The prior core CPI year-to-date was 2.6%. It came in at 3.4% this morning. That is some jump for any country really, but for usually well-anchored and low CPI country, this is pretty much of a jump. And as people in the room know, I was already looking to get back a bit long Norwegian kroner, because the fact that well, the global picture where Europe has to diversify from Russian energy, it is really going to help countries like Norway. And although the Norges Bank is selling Norwegian kroner every day and buying currencies for their oil fund and global fund in Norway, it is countered by Norwegian kroner tax buyers because of the exports bringing in so much money. So I still think Norway is going to be a beneficiary. And since I was looking for clues on the ECB and everything, my bias was to start to buy a little bit of Norway again. I did so yesterday, just ahead of this CPI coming in, and today we got the confirmation of this high CPI, and Euro NOK is coming off just a little bit. in my opinion, we have a chance of getting back into this prior channel where we moved out, we retested here, and then moved up a little bit because until last month they were selling 2 billion kroner a day and buying currencies, and always stabilized a little bit. But now I'm again on the more positive Norway bandwagon, as I think with such CPI numbers, there's a good chance that in a week and a half, I think, or in close to 2 weeks, we get a 50 BP hike from the Norges Bank. So that would put them like way ahead of, for example, the ECB. So I'm back long a little bit around this zone here, around this 10.17. I sold it, and I'm looking for a move back down close to 10 initially. And then see what happens if we get back into this dual line channel. We could have a look back at 990 ultimately. The reason why I'm doing it against euro and not against anything else is that I still think in my heart that the ECB will be far behind the others. There were some good levels on the dollar Norway as well, but I don't trust the dollar shorts for, as we can see here, we moved up to this 960 and a half again, actually no later than early doors this morning. It is a good resistance, but I really don't trust the dollar, so I prefer to express the long Norwegian kroner versus the euro right now. Perhaps after the next round of central banks next week, I will perhaps judge another currency, because I'm not a big fan of the sterling either. So sterling Norway might be a candidate, especially that euro sterling is holding well as well. So that for this one, and then let me quickly move over to our daily metal view. Gold for me in this range, it's turning around this 200 day moving average, where again they're bang on it, 1842 right now. I really need to see a break of, to start with, 854, 855, and then I would really get positive if we can break this 1870, 75. Downside still the same, 2835. Watch those supports, but for the time being, very neutral in there. Silver, silver is a complicated one, especially if China is going to maintain a part of their lockdowns and preventing the global economy from really reopening much more. This thing is a bit at risk, in my opinion. We tried very often to break. We've had like many tries to break above this 22 figure 15 zone, and we forces to admit that this thing has very little elasticity on the top side, and we straight away came back under it, and now we are like putting this 2140, call it 4045, in danger. So it's going to be interesting on the CPI this afternoon for this one, because it's the metals are somewhere still inflation trades, inflation hedges, but this thing could be this in gold could get a little bit jumpy this afternoon. So watch out if ever it would go sub 2140, or we manage to break above 221012 again. Then we might see deeper moves, deeper moves in silver. And then a quick look. Since the past couple of days, I don't really trust those reopenings in China for one, but that's not the main reason. I think PBOC is still on an easing path, and they've been injecting liquidity again. Again this week we had up and down news about IPOs. First of all, the anti-IPO would have been agreed, and then they retracted it, and so we still have to wait on that. There's a bit of a trend line coming in here. I bought it. I tried to buy it once, and then wasn't sure yesterday on after the ECB, because the dollar was looking a little bit heavy, but then afterwards the dollar recovered, and then looking at the China news overnight, I bought it again this morning at 669. I will have a look at this line in the short term, but ideally this zone here just below 665 I should be supported. If we can't keep the supports around here, I will reevaluate my strategy on the dollar China. If in turn we start to break above 672.5, 673 again, I think it's a positive sign for dollar China to go and test back up in around the 1680. That for that one. Yeah, I'm a little bit short Euromex. I anticipated the break here. It's really tiny because this thing is volatile. But then with the dollar coming back, it's back above this trend line. I'm keeping it for now because there's a bit of a resistance is building, but it's fragile, this one. See what happens if we trade it around 21, basically. I will see if I keep it or not. I was trading dollar EM short as well, but apart from a few scalps, it didn't really work. And now dollar rand is back below this 1538.43 that I showed the other day. This little zone here, 38.43 that was, and it shot back through up, and we're already trading back into a 58.65 resistance here. So be a bit careful on the US CPIs this afternoon. I think the emerging currencies could be, if the yields spike again, vulnerable. If the CPIs tell the market that they have to revise their US yields a bit to the downside, those things could actually go straight back 1%. And that's about it for me for now, Ryan.
Yeah, thanks very much, mate. Good stuff as always. I'll take the screen back. Where are we going? Let's have a look. Where are my buttons? There we go. Yeah, $1 is one I'm keeping an eye on as well, just with this new or fresh lockdown news coming from China. I did want to try and get it up in this 680 level, but we never got that high in this move here. I prefer the short side. I'm not looking really to buy it on any sort of China weakness, but I think that it's going to be more contained than when we saw this big move up here when a lot of the worries were coming out. So I'm going to be looking to see if we get a push up towards these recent highs, see if they hold again. Maybe we look for a triple top up here into that sort of 78, 79 zone, or even up towards the highs there. Again, from the point of view of looking at getting shorts and looking for a decent move down, back under maybe the 660 area. If you want to draw a trend line from these 2 points here, that will give us a move probably somewhere down at 658, something like that. But yeah, Kay wants to snipe it from the long side. I'm looking at playing a move up to get short. So there's always two ways to skin a cat in trading. We can both be right, we can both be wrong, we can both make money, we can both lose money. That's the beauty of trading. You can have different opinions, different strategies, and you can both still make money. I just want to ask you folks in the room, how did you guys view the ECB? Did you trade it? Were you in trades? And I know some people were looking at Euro CAD and things like that. So let us know how you got on, how you see the euro moving forward. Are we right? Or is my thinking right that I don't see any real big downside? Or do you think that this is the end of the euro and it's going to 103 again or something like that? So let us know in the comments there your views on that while we take a look at a couple of other prices. One thing I did want to note quickly it doesn't usually pop up on a lot of calendars. We've got credit ratings for the UK and Spain today. They come usually after the stock market close. No one's really bothered about those more recently. I'm highlighting it particularly for the UK because as we're seeing countries raising rates, that does put a pressure on debt burdens. And what the credit ratings look at is to see whether those pressures stay manageable, or if they get out of hand, it could lead to issues with credit. And if they start lowering ratings or warning on ratings, what that can do is it has an effect on investors, things like funds, because some investors will only invest in countries that have certain credit ratings or assets that have certain credit ratings. So if they start to get lowered, you can see outflows because those investors can't invest in stuff. If you've got a AAA rated country and AAA rated assets, investors that invest in those, it suddenly drops to AA's or worse. Investors will have to exit because they don't want to be invested in stuff that's a lower credit. That can cause outflows. That can bring moves in currencies and FX markets. So that's something to keep an eye on. I'm not saying it's going to be a big event today, but for the future, as I say, with rates rising around the globe, it puts pressure on debt levels, which then the credit ratings, the credit companies keep an eye on to make sure there's no problems coming there. And as I say, that can be a knock-on effect to investors, and we see moves in currencies as traders get out. Right, so let's have a look. What have we got going on here? Mike says it was a good old buy the rumor, sell the news for the euro dollar. Yeah, it looked that way. Bran, he said he got slaughtered on euro dollar. I hope not too bad. Michael, you found it unhawkish. Yeah, that's what we were talking about yesterday on the cheat sheet. Yeah, the Lagarde seemed all over the shop. She was in Amsterdam, so maybe she'd been to one of those cafes that they have there that sell anything other than coffee and beer, and the ones I'm talking about. Gavin, talking about Sunak getting the blame for UK wasting 11 billion on not taking out insurance. Now, I did see that headline last night, and it bugged me a bit because it looks like a typical bit of or biased reporting from the FT there. If you actually read this article, basically what it was saying that Sunak has lost 11 billion because he didn't take insurance out against rates rising, to do with the Bank of England's QE, and repayments of interest and that sort of thing. But they actually put a link in the story itself to a prior story, maybe about a year ago, where Sunak actually warned that if rates rose, the bill could be about 25 billion. So in effect, if you put it all together, they're saying he's lost 11 billion. He hasn't lost anything. This was going to be paid out anyway, but it's 11 billion instead of 25 billion. So you could spin it that he's actually saved 14 billion. But this is something, the way the press has spun it this morning, as if it's playing another blame game on Sunak. It seems the press is after Sunak a bit at the moment in the UK. And so here we are again seeing a headline being spun, but if you look into the details, potentially it's not as bad as what they make it out. Let's have a look what anyone else is talking about here.
Excuse me, Ryan,
yeah,
there was just above, because I think I missed that one when I was updating on the Norway. Somebody was asking where I would add on the Euro Noki. I think if we get a bit of a spike, just around the 1022 seems to be a decent level. And if we're getting closes below 1010, 1008, it might be worth pushing a little as well. But per definition, I'm a little cold on selling into dips already, though. So that's with a word of caution. Yeah, go on, Ryan. Sorry.
Cheers, mate. And yeah, we've got Gregor in the house. Hi, Gregor. Who's our Elliott Wave master at ForexAnalytix. Is why does the ECB not comment more about the euro exchange rate and on price stability? Since we know eurozone is net importer, high euro should help fight inflation. or are they waiting on parity? You're not in the parity camp, are you, mate? Yeah, you know, a lot of the waffle on the currency is always half-hearted, really, from the ECB. You know, we had that stuff where every time the euro gets to 119, they come out and comment. It's all, for me, it's all swings and roundabouts with currencies. For if you're talking the negative side from the import side, you've got to look at the positive side from the export side, and vice versa. So, you know, if a currency's strong, you know, there's always pain on one side and benefits on the other. Why they don't talk about the currency? They're happy with it lower. It helps them out. You know, even if they are a net importer, you know, it does help with the export side as well. You know, a higher currency would be better, you know, particularly if they're paying for things like energy in dollars. But then with that, you get the other side of the coin. You know, so it's always 6 of one, half a dozen of the other for me. If we got down to parity, somewhere like that, or, you know, really down that way, then you're going to start to see them picking up the rhetoric on the currency. But, you know, these guys, these central bankers, they don't worry about, you know, 300, 400, 500,000 pip moves. They're interested in big stuff. You know, if we're below parity or above, you know, 130, 140, that's where they really set their stalls out as the currency being in a difficult position, shall we say. Just a question there from Carsten on looking at an Aussie Kiwi short along the China new lockdowns.
I have it on. I forgot to say I have it on. I sold it yesterday, Carsten.
Keeping secrets from us, are you?
No, hey, it's a free webinar. People should come to our room to know what we do. Everything we do live, you know. A few of us sold it yesterday, pretty close actually to the top, around 111.40. We went short. One could say that Aussie Kiwi will be heavy because of the China situation, which has been partially traded prior to this. But I also think that now the RBA effect is out of it. So the correction that we saw, or the move higher that we saw after the RBNZ, and so the RBNZ created a move lower into the 109s, and then we saw like, oh yeah, but now we are going to have the RBA around, and yields started to rise. So we had this 200-point spike higher, but that's the other reason. I think the effect is now relatively gone, and therefore we started it's still relatively small, because I would like to see a retest and a confirmation that we have seen the top to really sell more. But indeed, there's a few patterns as well who could how shall I say, confirm this setup for a move back down into the close to the 110 and 110 and a quarter for a starter. So yeah, we are looking at it.
Yeah, and you know, as I mentioned yesterday, I'm a bit more bearish on the Aussie dollar, because it's similar to what we've seen from the ECB and the euro. You know, here we have a bank hiking. We're 2 hikes in, and already you know, Aussie banks are forecasting rate cuts as early as next year. So again, you know, there's the where the currency should be running higher, and Kay's mentioned this, you know, don't look at just the inflation impact for why rates are rising. But generally, you know, the dollar and the Fed are still front running. They're still at the front of the race in terms of the divergence trade. You know, they're going hard and fast, more so than the other banks, even if the other banks are trying to play catch up with 50 pip hikes like the RBA. It's still the Fed that is the big game in town, and they're still the far bigger central bank. And that's a reason why the euros crumbled after the ECB, because of the divergence trade. The same for euro sterling, the same for the Aussie when you match it up against the Fed. So yeah, you know, Aussie generally, I'm still bearish because of these factors, and they are they are the more dominant factors at the moment. You know, Australia could have a good set of data coming out, but it will get trumped by good US data because of the size of the banks involved. So until that situation changes where the Fed is reaching a sort of peak, they get to their neutral rate, or you know, the other central banks are slowly starting to catch up. The Fed may get to a point where they pause and the other banks catch up. I don't think we're going to see a big switch in currency plays against the dollar. Hence why I'm a bit more bearish on Aussie dollar now than I have been previously. Let's put Aussie dollar on the screen there so you can have a look quickly. So just a quick technical look. I showed this other day, you know, I have various zones that I look at. Had this zone down here. Let's stick it on an hourly quickly. I won't spend too long here. So this was one of those on-off support zones, support resistance zones. We came down, broke it, held it as resistance, continued to hold the zone as resistance. Further downside is possible. We had to move down sub 108, sub 71. You know, if we maintain this move under here, we should have another look down towards that area. If we start to see it hold under the trend line, under the 71 handle, we're potentially going to get a move back down into the 70s. So there's a quick technical view there. Any other questions going on here? I don't think I've got anything else to offer today. Do Euro bonds affect the ECB's decision as to how much to raise and how aggressive? I don't think it influences their view, Michael. But as we know, they are worried about spread blowouts. So it's mainly the spreads we're going to look at. You know, we're seeing the peripheral spreads jumping today. That's what they need to keep an eye on. That's a bit of their own making based on and a reaction to the meeting yesterday. So it's again another one of those things we have to wait and see to see how that develops. Is it just a move reacting to the ECB, or is it the start of something a bit bigger? Right. Okay. Well, I'm out of topics to talk about today. It's been a fairly long week. I hope you've all had a successful week. I hope you've come through it trading very well, made a lot of pips. And if not, if you haven't had a good week, I hope it's not been too damaging. Reminder, if you are struggling with your trading, if you are having any problems, you know, you're hitting some psychological barriers in your thinking, you know, please come along and to the chat room and join our community where you'll get some help. If you want to do that, there's a link up on the screen there. If you come via Forex Flow here, I've got a exclusive discount, 20% off your subscription for the lifetime of your subscription. So you can take advantage of that. You won't find that discount anywhere else. And quickly, you know, if you want to join our traders funding program, again, you can come to our site. There's a tab on here, the funding program, or look up the site itself. And you can trade our money or the ForexAnalytix money if you pass the assessment period. But apart from that, thank you very much, boys and girls. I hope this week's been good for you on the Flow Show. We've enjoyed your company. It's been a good week. We had a very good session, some very good sessions this week, I think. A lot of involvement for you guys and girls. Much appreciated. Thank you for coming and giving us your support. Good luck today. Watch that CPI. And Kay, good weekend to you. And I wish everyone a good weekend.
Yeah, absolutely. Have a great weekend, everybody, and safe trading this afternoon.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.